Imagine you own 10 shiny rocks. One day, a friend walks by, stops, and offers you $2 for just one of them. You happily accept the trade. Now, based on standard market logic, your remaining 9 rocks are suddenly worth $18. Combined with the cash in your pocket, your total personal net worth has blasted off from nothing to $21 in a single afternoon. Your friend is thrilled, too. The rock he bought for $2 is now valued by the market at $2. His wealth has instantly validated itself. The rock market is absolutely ripping, logging a massive surge in value in a single day. But if you step back and look at the actual reality of the situation, absolutely nothing about the rocks or the people holding them has changed. They are the exact same physical stones. No new utility was engineered, no new infrastructure was built, and no real tangible value was created. This silly rock trading loop is a perfect, simplified snapshot of exactly how global net worth has completely detached itself from real economic productivity over the past 2 decades. Economists love to announce that the world is wealthier today than it ever has been before. But beneath the shiny surface of our multi-trillion-dollar modern economy sits an uncomfortably massive anomaly. Global debt has officially surged to an unprecedented record high of $353 trillion. That means the collective liabilities of humanity now stand at a staggering 305% of the entire annual economic output of the planet. Since the world cannot borrow money from Mars, and we only ever lend money to ourselves, this brings us face to face with a truly bizarre paradox. Who are we actually trying to pay back? Why is the global financial engine systematically addicted to borrowing? What is this immense ocean of leverage doing to your daily cost of living? And perhaps most importantly, how does this entire game end? To understand how we managed to trap ourselves on a $353 trillion financial treadmill, we have to go back to a time long before computerized trading algorithms, Wall Street hedge funds, or sovereign bond markets even existed. We have to look at what money actually is, and more importantly, what it isn't. At its absolute core, wealth is not money. Money is simply the scoreboard. Actual wealth is real-world value. Every single time someone pays you for a good or a service, economic value is simultaneously generated on both sides of that transaction. You trade your time and labor for a physical token, and you use that token to claim someone else's labor later down the line. These basic exchanges are as old as civilization itself. For thousands of years, humanity tried to keep this scoreboard honest by tying it to tangible physical assets. We used gold, silver, bronze, and copper. If a king wanted to fight a war or build a sprawling monument, he had to physically possess the precious metal required to pay his soldiers and stonemasons. If the treasury was empty, the spending stopped. The system had a hard physical ceiling. Debt existed, of course, but it was constrained by the absolute physical reality of what was sitting in vault rooms. But everything fundamentally shifted when the world realized that physical tokens were far too heavy and inefficient to facilitate a rapidly growing global trading network. We replaced the gold with paper receipts, and eventually, we detached those paper receipts from gold entirely. We stepped into the era of fiat currency, money backed by nothing more than government decree and the collective psychological trust of the people using it. This change permanently broke the ceiling. Money was no longer a scarce physical commodity dug out of a mine. It became a digital entry on a banking ledger. And the moment money became purely digital, it unlocked a profound macroeconomic superpower: the ability to create capital out of thin air through the mechanism of credit. When a modern bank issues a loan, it doesn't physically walk into a vault and hand over a stack of cash belonging to another depositor. It simply updates a digital spreadsheet. It creates an asset on its books, the loan, and pairs it with an offsetting liability, the deposit. In an instant, new money supply is systematically injected into the economy. Debt, in our modern framework, isn't just a tool for buying something you can't afford today. Debt is the literal fuel that creates the money supply itself. If every government, corporation, and household on Earth simultaneously paid off their debts tomorrow, the global money supply would effectively cease to exist. Now that we've set the stage, put on your investor cap for a minute. If we want to genuinely diagnose the true structural health of a public corporation, simply skimming its annual income statement isn't going to cut it. An income statement merely shows us what a business earns and what it spends over a brief 12-month window. It provides absolutely zero insight into what that company actually owns, what it owes, or what it has saved for a rainy day. This is why Warren Buffett famously spends the vast majority of his time scrutinizing balance sheets rather than income statements. The balance sheet is where the underlying financial strength or vulnerability of an enterprise is truly revealed. In the context of the global economy, gross domestic product, or GDP, is essentially the equivalent of looking at a giant macro-level income statement. GDP tracks the total monetary value of all finished goods and services produced within a country's borders over a specific time frame. It measures economic flows, the raw transactional velocity of consumption, investment, government spending, and net exports. But just like a high-earning individual bringing home $200,000 a year can look fabulously successful on paper while being completely broke and drowning in credit card debt, a nation's GDP tells us almost nothing about its structural net worth. To get a real unvarnished understanding of global economic stability, we need to stop obsessing over the income statement and look directly at the consolidated global balance sheet. We need to map out our total net worth. So, if it's that obvious, why don't politicians and mainstream media outlets talk about national balance sheets more often? Well, tracking GDP is a remarkably straightforward process because transactions leave a clean, undeniable paper trail of receipts. Assessing global net worth, on the other hand, is an accounting nightmare. It relies entirely on valuations, which are often nothing more than a highly complex web of assumptions and educated guesses. If a nation constructs a fleet of high-speed trains, recording the transactional cost in GDP is simple. But how do you accurately calculate the true long-term value of a country's natural mineral reserves, its intellectual property, or the massive proprietary AI models currently being trained by tech conglomerates? What is a square mile of real estate actually worth if no one has bought or sold property in that neighborhood for years? When you expand these calculation hurdles across the entire globe, consolidating data from hundreds of different countries using entirely different statistical methodologies, you realize it is the mathematical equivalent of trying to fit a square peg into a round hole. But despite the sheer complexity, international economists have done the math. And when you look at the global balance sheet, you find that our wealth is divided into three distinct buckets: financial assets held by corporations, financial assets held by individual households and governments, and non-financial, real assets. If we look past all the dense financial engineering, all the loans, bonds, derivatives, and bank deposits eventually cancel each other out and net to zero on a global scale. Therefore, the true net worth of the real world is simply the total valuation of our physical and intangible real assets, which currently sits at roughly $600 trillion. And who are the ultimate shareholders of this $600 trillion corporation we call Earth? Individual households. Households hold roughly 95% of all global wealth ownership, either directly through real estate or indirectly through corporate equities and bonds. Corporations themselves don't actually own net wealth. Their physical buildings and machinery are entirely offset by the liabilities of the debt they owe and the equity shares they issue to the households that own them. This brings us directly to the core crisis point of our story. Historically, global net worth and global GDP moved in near-perfect synchronized lockstep. If a society built more factories, grew more food, or invented more efficient tools, its GDP grew, and its underlying net worth naturally rose to reflect that real productivity. But around the year 2000, the baseline rules of global capitalism fundamentally broke. The two growth rates violently diverged. Since the turn of the millennium, global net worth has expanded at a velocity that far outpaces modest global GDP growth. By early 2026, global debt stockpiles hit that historic high of $353 trillion. Governments and corporations are now borrowing an astronomical $29 trillion from the bond markets in a single year, a 17% spike compared to just 2 years ago, and double the borrowing levels logged a decade prior. If we were growing our collective wealth by aggressively investing in highly productive assets, the macroeconomic equivalent of a worker buying a better shovel to triple his daily output, this massive explosion of credit would be completely fine. Real productivity would accelerate, GDP would keep pace, and the real economy would easily generate the income required to service the debt. But that is completely opposite to what is actually happening. The vast majority of growth on the global balance sheet has occurred in non-productive assets. Our global net worth is skyrocketing, but our structural ability to produce more real value is stalling. A staggering 75% of all net worth growth generated since the year 2000 has been driven entirely by asset price increases, pure asset inflation. And we aren't just talking about standard consumer inflation here. That only accounted for about 38% of the price growth. More than a third of the world's wealth expansion was simply paper wealth creation, while real physical investment into productive infrastructure crawled in at a measly 28%. We are not getting structurally richer. things are just getting systematically more expensive. Nearly 70% of all of humanity's cumulative generational wealth is now tied up in a single asset class: real estate, the literal land we live on, and the structures built on top of it. Meanwhile, despite living in a hyper-technological era dominated by silicon chips and digital networks, actual intellectual property and software account for less than 5% of the world's total assets. We have built a world where the primary mechanism for getting rich is no longer inventing something new or manufacturing something efficiently. It is simply hoarding fixed plots of dirt and waiting for debt to bid the price up. How did we fall into this self-reinforcing trap? To find the smoking gun, you have to look directly at the actions of global central banks starting in the early 2000s. Following a series of market shocks, central banks embarked on a historical experiment, dropping interest rates to near 0% and embarking on massive quantitative easing programs to flood the banking sector with liquid cash. When interest rates hit zero, the traditional incentives of a capitalist economy completely flip. Keeping your money in a standard savings account becomes a guaranteed way to watch your purchasing power slowly erode against inflation. Lower borrowing costs mean households can take out massive, multi-decade mortgages to aggressively outbid each other in tight housing markets. This sets off a dangerous compounding loop. As non-productive asset valuations soar, the paper capital gains they provide easily outpace the operating returns of real, productive business investments. Why would a venture capitalist or an ordinary investor risk millions funding a risky new factory that has to manage labor, supply lines, and complex regulations when they can simply dump that money into premium residential real estate or inflated corporate equities and watch their paper wealth expand completely effortlessly? Because income growth isn't keeping pace with these skyrocketing asset prices, a massive structural gap opens up. And there is only one thing available to fill that gap: debt. For every single dollar of real physical investment made over the past 2 decades, our financial system has generated $2 of new debt. Even when everyday households try to invest productively by buying shares of public companies on the stock market, the mechanism breaks down. In highly active stock markets, corporate enterprise valuations have entirely detached from their underlying book values. Individual retirement accounts pump billions into corporations every single week. But instead of using those cash inflows to invest in advanced machinery, research and development, or higher worker wages, major corporations have become the single largest buyers of their own products. In recent years, corporations have spent over $1 trillion annually purchasing their own shares through stock buybacks. It is an accounting loop designed to artificially reduce the number of outstanding shares, inflate the price of the stock, and maximize executive bonuses under the guise of shareholder return. Wealth is simply breeding more wealth on paper, while real-world economic production hollows out. This brings us to a highly precarious situation. Because asset prices are entirely dictated by the latest transacted market price, our global wealth is largely a grand psychological illusion. If a stock market panic or a real estate freeze causes sentiment to shift, trillions of dollars in paper wealth can vaporize into thin air overnight without the underlying physical businesses changing at all. And while paper wealth can disappear in a flash, debt does not. A mortgage, a corporate bond, or a sovereign treasury note remains locked at its face value regardless of what happens to the market. As central banks navigate the structural fallout of this loose monetary era, they have been forced to push interest rates higher and shrink their balance sheets through quantitative tightening. The global money supply is actively tightening, and in an environment burdened by $353 trillion of leverage, that is an incredibly volatile fault line to sit on. When money becomes tighter and borrowing costs climb, the corporate and sovereign debt markets enter a dangerous refinancing bottleneck. According to data from the OECD, governments and corporations are currently facing an unprecedented wall of short-term refinancing risk. In fact, an astonishing 78% of all borrowing conducted by advanced OECD governments in 2026 is being deployed for one single purpose: to refinance existing debt that was taken out years ago at rock-bottom rates. They aren't borrowing to build new schools, space programs, or green energy grids. They are borrowing just to pay off the old credit card bills. If investors suddenly lose confidence or demand higher yields to hold this mountain of debt, the global economy risks triggering a catastrophic balance sheet reset. If a rush to liquidate paper assets begins, market prices will plummet, forcing loan-to-value ratios to skyrocket. Households, corporations, and governments will be forced into a painful period of deleveraging. viciously cutting back on everyday consumption and halting investments just to prioritize paying down fixed liabilities. This is the exact structural nightmare that struck Japan after its historic asset bubble burst in 1990. A multi-decade era of economic stagnation, deflation, and frozen growth where an entire nation works around the clock just to clean up a broken balance sheet. How can the global economy escape this self-inflicted leverage trap? There are essentially two paths forward. The first path is to aggressively accelerate real productivity. If we can grow global GDP faster than asset prices and debt piles, the real economy can slowly catch up to its inflated balance sheet and restore a healthy equilibrium. Many tech advocates hope that the current multi-billion-dollar investment cycle into artificial intelligence might be the productivity miracle we desperately need, provided the technology actually optimizes real-world workflows rather than just inflating another speculative tech bubble on the stock market. The second path requires a fundamental structural redesign of our tax and incentive frameworks. In economics, you systematically get more of what you subsidize and less of what you tax. Right now, our policies heavily subsidize speculative asset hoarding and heavily tax productive labor. Implementing targeted economic tools, such as land value taxes to disincentivize holding empty real estate or vacant property levies, could shift the calculus. Just like a steady 2% inflation target incentivizes people to pull cash out from under their mattress and invest it, small structural costs on non-productive assets would force global wealth holders to stop chasing simple paper appreciation and start funding real value creation. Ultimately, debt is a tool that allows humanity to borrow prosperity from the future to build something meaningful today. But when the debt is used entirely to bid up the price of things we've already built, the future gets stripped of its potential. If the vast majority of our $600 trillion global net worth is backed by nothing more than an accounting scoreboard of debt, we have to ask ourselves a very serious question. Are we actually any wealthier today than we were 20 years ago, or are we just playing a very expensive game of rocks? Thanks for watching, mate. Bye.